Hey, good morning, everyone. Marty Mazzora here. It's the 13th of February, Tuesday, 2024. This will be your midweek market snapshot. Clients, you'll get it linked to an email. Tomorrow morning, it'll be the Wednesday morning message. In this morning's written note, I present the alternative case to the case that I illustrated for you yesterday, leveraging two different analysts. One, Peter Berezin from BCA. He's now in the recession camp for this year, not bullish equities like he was last year. And this morning, Jim Bianco making the case for higher interest rates, which he's feeling pretty bolstered this morning because of the higher than expected CPI print that's doing a real number on markets, at least as I speak. And he expects a breakout in yields going forward. I know he's not in the recession camp this year. And that also, as I said in the intro, like I said in yesterday's intro, is not good for stocks. The stocks are in a really tough spot. In either economic scenario, it's just that immaculate soft landing would be the place they work. And I think despite what you're hearing in the financial media and so on, that one still deserves to be met with a more than a small dose of pessimism right here, or skepticism, maybe I should say. Okay, but as for the technicals, recall that I keep pointing to these bearish patterns, right? And, last time I said, or I think the midweek message or the end of week message, I said, these don't always play out, but they're pretty high probability, and this one looks, pretty compelling to me. And it also looked that way on the hourly chart this morning. In the interest of time, I'm just going to stick to the dailies. And so here's the S&P, kind of rolling over, about to get a sell signal there on the MACD if this keeps up. And the RSI coming down off of overbought territory. As you recall, I've been more concerned pretty much across the board on the NASDAQ 100 and the stocks that are in that, which are those, as the S&P is as well, but even more so concentrated in those big, super high-flying tech stocks. You can see it's broken down just below the rising wedge pattern. That would be your sell signal if you're a short-term trader. Although this chart on Bloomberg is a 15-minute delay, and it's up from there. This is 429.50. We're at about 430 right now. Only down about 1%, and I think we were down closer to 2 at the worst of it today. The breadth, though, is pretty broad-based, and so equal weight averages, most sectors are taking a bigger hit right now. A little buying right now, maybe in tech, hopeful people thinking maybe this is a buying opportunity. So again, though, folks, this is just the stuff I've been showing you now, I think, for weeks and weeks. Bearish divergences on our momentum indicators, bearish rising wedge pattern, not what you're looking for if you're a bull. And remember, I was pointing to the opposite looks when we were short-term bullish during, I think, most of the pops that we've gotten during this bear market so far. And then for small caps, recall last week I did say that this was the one I was constructive on. Now, I did say I'm not bullish small caps, but this was a pretty compelling looking chart. At the time, we had just broken out from a falling wedge. I said, short-term traders, there's your buy signal, right? And we had somewhat of a bullish divergence on the RSI. And sure enough, that morphed into 3 really big days for the small caps. I think they're up like 6%. Now, on today's print, those people took today's inflation print as an excuse to sell it off hard. And look how quickly I don't know if you can call those gaps, but look how quickly we've given back most of that rally, although bounced right off of the 50-day moving average. So we're kind of eyeballing small caps. We don't own them yet. We tend to own them in not small fashion coming out of a bear market, but typically that's coming out of recession. And we really haven't had our recession yet. And there's still these gaps to fill. So what's interesting about today, of course, is the market is selling off on prospects for hotter inflation. And I discussed the forward-looking inflation prints, talked about that last week. One of our research partners, their forward-looking inflation indicators are beginning to bottom, perhaps look up. That's problematic for the market. I have to tell you, though, folks, I think the setup here, and we'll see, and I'm not telling anybody to trade this, is that you get this heat up, or this fear that inflation's heating up. Market sells off hard, only to come back off the boil here over the next few weeks or months, because our view is that recession odds are still too high. And in a recession, you're going to get yields to come back down. So there is this scenario where stocks take a hit for a little bit, tech in particular, you would think, because their interest rate sensitivity, although they're beginning to outperform today, they're only down 1% now. And then when suddenly reality comes back to the fore, remember all the consumer-related data I showed you in yesterday's written blog post, and it is the consumer that is this economy, right? So the economy confirms that it's weakening. Inflation, begins to go in that direction. There is a stagflation conversation that we'll be having that I think is way beyond zero odds for the extended future. So it could be stubborn inflation even as the economy is falling. We'll explore the prospects for that. And I do think there are prospects for that going forward. But for the moment, again, inflation heats up a bit or scares the market a bit. Market has to adjust because it's discounting way too much in terms of Fed rate cuts if indeed we're not going to have a recession and inflation is going to be sticky here. And then perhaps things do roll over. Market gets a big pop out of that until the earnings reality of recession come in. And there you get your last leg of the bear market, and it won't be pretty if indeed that's what's going to happen. We don't know that that's what's going to happen. We do have enough concerns around that's really data and historically based that has us continuing to hedge against something big to the downside, being a little more liquid than we normally would be. Gold would do very well in that scenario. Of course, it's getting hit today because of higher yields, but it would do very, very well in the scenario that I just laid out ultimately during that last leg down, we think anyway. And then recall I said last week, while stocks were somewhat bucking the higher yield trend, it wasn't my view that that's going to stick. And I said, if this indeed turns out to be a bull flag, it's going to be very bad for stocks. And this is yields. And you can see the big pop in yields today. And you know what stocks are doing. As I speak, the Dow's down, 500 points. NASDAQ is now down 1.1. S&P's down 1.1. Small caps down 3.3%. And then the dollar, same thing. We drew this potential bull flag, really bad for stocks. Of course, dollars wrapping up there today. And you can see this was a bullish setup here for sure. As for breadth, I'll just show you Bloomberg's IMAP screen. This is the S&P 500. You can see it's down over 1%. 92% of the stocks are in the red. Makes sense. And then, you can see like utilities are getting slammed. Of course, they're very interest rate sensitive. So, folks, this is that picture I've been talking about now for, months and months and months and months. And that is the upside breadth when the market's been up has been horrific, save for November and December of last year. But other than that, all of last year and the beginning of this year, the breadth has been about as bad as it could be. And that's just not a hallmark of a healthy market. So the market goes up. Like last week, we had big up days and we only had half the stocks or 40% of the stocks going up. Well, here's a pretty good down day and everything is going down. So again, that is what I've been talking about. Now, this is just a day. This is not a trend make. A lot of people want to buy the market. I've showed you that sentiment is way out over its skis. This morning's Bank of America mutual fund survey came out. They're the most bullish they've been in years. AAII, advisor sentiment, all of that looks as bullish, if not more bullish, than they were coming into 2022. And you remember how ugly 2022 was. So remember I said, I think it was early last week, there's a reason why these traders who trade sentiment have such high conviction, is because it really can be telling. And so a lot of bulls are freaking out a little bit this morning and selling. Certainly nothing, in my view, to panic about. Clients, of course, we're going to feel days like this. We're going to have to. We're not hedging against 1% down drafts, but we're hedging against double-digit down drafts that we think, there's a not small risk of realizing during the course of 2024. So we're just going to keep doing what we do, and I'm going to leave it right there, folks. Thank you, as always, for watching and listening. Hope you have a great rest of your day. Talk to you later. Bye-bye.